Uncertainty around trade and the economy has driven market volatility recently, but how are investors positioning themselves in this environment? Joining us now to discuss is Andres Rincon, Managing Director and Head of ETF Sales and Strategy with TD Securities. Andres, always great to have you on the program.
Thank you for having me.
April was quite the month. It's amazing when you take a look at a 1-month chart of the S&P 500, where we were before the tariff announcement of April 2nd and where we ended up. Quite a roller coaster ride.
That's right.
The buy the dip mentality, did that show up because it would have been advantageous for some?
Yeah, interestingly, you would have thought that everybody would just went to cash, basically, and given all the volatility and uncertainty, but we're actually seeing still a lot of activity in equities. I would say compared to last year, though, quite more modest and reduced, just to be clear. So there was some buying off the dip. We did see still interest in U.S. equities, but so call it, let's say, 40% of the flows into equity ETFs was in U.S. equities, but that was much stronger last year. So I wanted to put that into context because it's important. A lot more money today is going to international equities, European equities, European defense, which I think we talked about last time. So there's a lot more interest in the UK, Europe in general today than there was, say, last year. Also, EM equities in general is seeing some momentum there. So all in all, you saw about, just in Canada, for example, you saw $8 billion go into, call it, in the month of April, you saw go into U.S. equities, but 5.3 into international equities. Just to give you perspective, and that number was very well skewed towards U.S. equities. So there's clearly some momentum and change in that space. In terms of equity ETFs, you saw a lot more interest in low vol. So there is definitely some interest in more a safe haven kind of equity world, but also a lot of money still go into fixed income. So the big transition from last year to this year is we've seen a change in allocation more to fixed income versus last year, which was very much an equity heavy year, obviously pre-Trump, let's say. This year we've seen a lot more money go into fixed income. So what's really interesting is that the direct investing channel, that your channel that we're talking to here, has a keen interest in money market ETFs, a little bit more so than high interest savings ETFs. Money market ETFs are paying a little bit more than high interest savings ETFs, so there's a lot more interest there. On the advisor side, we're seeing still a lot more interest on your traditional fixed income, ag, and whatnot. But money market is hitting it out of the park in our DI channel, by magnitudes of numbers. Flows into money markets is much larger than equity and fixed income ETFs.
Really? Wow. So it does give you some picture of the mentality of everyone, because, these are uncertain times. When we think about ETFs, when we think about people moving to the U.S. market through ETFs or Europe, I often think of a big basket of something that's, tracking an index. Single stock ETFs, are people sort of warming up to those?
100%. They've become very popular in both U.S. and Canada. These products are bought for a variety of reasons. So obviously people might ask you, why do you buy a single stock ETF where you can
single stock? Yeah.
You can just buy the single stock. But in reality, they offer a different outcome. So what is generally offered in the ETF vehicle is a leveraged version of that stock and or a leveraged yield version of that stock. So that's what's really popular. And actually most of the flows go into the yielding version of that stock. What's really popular, for example, is there's some tech stocks that say they're not really high dividend paying stocks. So some of these ETFs offer a yielding version of those, and some people find that attractive. So they're seeing a lot of flows there. I would say 2/3 of the assets going into single stock ETFs go into the yielding version versus just the leveraged version of that ETF. But they're seeing incredible growth, especially in the really, call it popular names on the street, like a MicroStrategy, like a Tesla, like an Apple. Those names are very popular in ETF form.
What do you need to be aware of, though, if you're playing in that space? If you're taking a look at that and say, hey, there's a yield here, let's go there.
Oh, there's many things that you have to be aware of. For starters, a lot of the leveraged products, the leverage varies wildly from just 1 quarter turn, so 0.25% of leverage or 25% leverage, let's say, to 2 times, 3 times in some cases. And depending if it's US or Canada. In Canada, they just go to 25% extra leverage. So it's relatively modest in Canada. So that means it's just going to add a little bit more volatility and or yield to that position. In the US, they can go to 2 times, let's say, or higher. So volatility is much higher. When you have a leverage product like that, they provide you with daily leverage, not long-term leverage. And that means that the outcome over a long period of time is very different than what you might think if you're buying a product that's 2 times. You're not getting long-term 2 times exposure, you're getting daily 2 times exposure, which means that the volatility of that stock heavily impacts the return of that ETF. And it might not be what a lot of people think. So I do encourage everybody to do their education with the leverage products. They're quite tricky in understanding them, and they're meant as trading vehicles, not really investing vehicles for the 2 times. Now, for the 25% ones, it's slightly different story there.